Hello, and welcome to Bridgeford Trust Company's Delivering Direction and Control podcast series. Our podcast series is designed to educate, challenge, and inspire listeners while keeping you updated on developments regarding modern trust law and powerful planning opportunities available, all in an effort to deliver direction and control to clients and their advisors.
Well, everybody, David Warren here with you again, chairman of our board and one of our co-founders, with the pleasure of leading our podcast series now. I think coming up on 60 episodes, we're probably exceeding it at this point. And I always say, especially now, this is probably the best part of my week when I get to talk to thought leaders. And over the last 2 or 3 years, I've just learned so much from the people that we've spoken to from quite literally all over the globe. We're always so humbled when we're able to attract the kind of thought leadership that's interesting to us in our industry. Bridgeford, as I say over and over again, is all about big ideas and being independent and finding really creative ways to serve large families. Which brought us to our work with Trusted Advisor, which Skyler's going to talk a little bit about, because that's how I met this fine gentleman and very unique and dynamic personality through that organization. But today is carrying on the tradition of talking to people with really, really big ideas and making a big impact in our financial wealth planning community. And his area of focus is something that's very much consistent with the work that we do, in so much as it's all part of the planning tool around tools for asset protection, tax play, privacy, and what Skyler's going to talk about is a series of planning tools that work unbelievably well in conjunction with South Dakota Trust, which is why we hold so much of what it is Skyler's going to talk about. So Skyler, welcome. I'm very happy you're here. Thank you for being here.
Yeah, thanks for having me, David. Appreciate this.
Absolutely. And a little bit about you that I learned when we first connected. But you're sort of a serial entrepreneurial person. That is, you've done all kinds of things in your career, and I want you to talk a little bit about it and what led you to the seat you're sitting in now. But I think before that, you had a pretty interesting background before you jumped into this career as well. But currently, you're with Leverage Capital Partners based in Naples, Florida, one of my favorite places on earth, and looking forward to getting there soon with you to go. There's one, I think I mentioned, one of my favorite places is Baba. It has the best lamb I've ever had, I think, in my life. I have to get back there, in addition to seeing you, of course.
I live 2 blocks from Baba. So.
Oh my gosh. Well, good. And I could walk to your place and crash on the couch. It's perfect. But seriously, your career is so dynamic and interesting, and I'm looking forward to getting into it for the audience. But there's something that I came across that really I love, and it made me chuckle, and I think it's a great way to start. You say on your website, on paper, I've built and exited multiple companies, but in real life, I'm still trying to remember all of my passwords. And I thought that was really great, funny, made me chuckle, and I think a great way to start. So again, Skyler, welcome. And before we get into what you're doing now, tell us about your background.
Yeah. So like you said, I was a serial entrepreneur, am a serial entrepreneur. I started my first company when I was a junior at Purdue, which was a life insurance brokerage. Mm-hmm. Grew that quickly to 40 employees in 20 states, which kind of led me to where I'm at today, but it's kind of a full circle moment for me.
So let me go back. How did you do that while in school? I mean, I guess you just took the test, became licensed and started building the practice while in school?
No, I was studying finance, was studying for my Series 7 at the time, wanted to work while I was in school, and I got a call from a guy out of the blue, ex-professional hockey player, won gold for Russia's team a couple of years as their goalie. He was like, "Hey, I want you to come and sell insurance for me." I said, "No, thanks. There's no way that's ever going to happen. Thanks, but no thanks." And he kept calling me, and he kept calling me, and he was like, "Let me fly you out to my company. I'll put you up for the weekend." And I said, okay, I'll take the free vacation in the Carolinas. So he flew me out there.
Good choice.
And then him, myself, and one other person, we ended up driving back to Indiana after the weekend. And he was like, I still see that it's, this might not be what you really want to do. So I'll give you another option. If you don't want to come and sell insurance for me, I'll teach you how to start a business doing the exact same thing I'm doing. He became my first mentor. I started my insurance brokerage, and that kind of started everything for me. And I grew up really poor, so I was the first to start a business in my family, first to go to college in my family. So he really got me on my feet.
And so how old were you?
I was just turned 19.
That is amazing. That is amazing. Well, congratulations. I don't know if you shared that, so that's pretty inspiring. So where'd you go from there?
From there, sold that after a few years to another brokerage, and then I started a personal training company, small company up in Granger, Indiana. That was
Okay.
the fun company, since I was a 3-4 sport athlete most of my life.
Yeah.
Didn't make a ton of money, but I had 5 full-time trainers. Did okay. I ended up selling the company 2.5 years later to one of my trainers.
So before we move on, what was your sport or sports that you played?
I swam in college, so
Excellent.
that was my best sport. And then basketball was like my passion, but I have multiple torn ACLs,
Yeah.
broken ankles, so I gave that up.
Well, so you talked about the fitness business being your fun business. So now that I know that about you, I could use some training. So when I'm in Naples, before we go to Baba, will you teach me how to work out? Is that a fair deal?
Yeah, absolutely.
I'll pay for the drinks. You just train me a little bit, and we'll go from there.
You're on your way. 6 ounce curls is where you start.
That's right. Yeah, I'm really good at that. I'm almost too good at that.
Yeah.
All right. So then they sold the fitness business, and then what happened?
Then after that, my first client from the fitness business, we ended up starting pharmacies around the U.S.
Pharmacies.
Pharmacy. So they got me into big business. We had topical pain cream pharmacies, compounding pharmacies for most people. And we opened a bunch of those. Big Pharma didn't like us. We got into the game a little late. We sold 37 of them, closed 10 of them down.
So you had 47 at one point, locations.
Yeah.
And how old were you at that point?
I was 23, going on 24. Yeah, so those guys bet on me and really showed me, what full P&L responsibility was. They taught me how to raise capital for the pharmacies. They taught me how to hire pharmacists, how to have conversations with physicians. They really projected my career, because right after that, during that same time, I started a medical device company, which ended up being my largest company. So it's been a crazy 15
So
years.
bigger than the pharmacies.
Yeah.
So
I was a very small shareholder of the pharmacies.
Okay.
I was just the young guy that had all the energy.
Yeah, exactly. I know. That's how it was when we started Bridgeford. I used to be a young guy that had a lot of energy. Well, so I have to say, unbelievably impressive. You have done more before the age of 23, 24 than most people do their whole lives, especially from an entrepreneurial perspective. So congratulations. I don't think I realized just how varied your history was when we first had our conversation. Incredible. Okay, so after that, right, you're going to tell me next you started a bunch of brothels in Nevada now? Is that what you're going to tell me? Is that the next move or no?
What's the thing in Minnesota that was going on? I started a child daycare service. It's closet billionaire. What's all the?
Oh man, that'll be the next podcast we do for a different platform. Yeah. But no, please pick up from where. So you got into the medical device company or industry. Talk to me about, and you said it was your biggest. So talk to me.
Yeah, it was my biggest. I owned 100% of that, and I basically opened independent labs for physicians. So instead of patients sending out their patients to hospitals, surgery centers, or to get their labs done outside of their facility, I built those labs inside their practice so they can keep all of the revenue to themselves.
Excellent. So what did you do? Is that still going, or did you sell that? What happened to that business?
Yeah, I sold that to private equity in 2018.
Excellent. That long ago. Okay. All right.
Yep, that was a while ago. And then we had 2 medical billing companies at the same time that kind of tied into that. And I was a minority of those.
So did you sell those as well with the same transaction?
No, different transaction, different company came in and bought us, but during the same time, about a year apart. So
after that, I'm afraid to ask the question, did you start another business?
Yeah. I ended up moving to Detroit. We started an automotive distributorship up there. COVID happened, everything shut down. Yeah. I lost a lot of money, learned some hard lessons, then started another business, learned some hard lessons, ended up moving to Naples. And then a friend of mine said, "Hey, why don't you get back into insurance?" And I was like, "Well, I'm good. I don't think I want to sell insurance like I used to." He's like, "No, this is different. He explained what he was doing, which is what I'm doing now. And What I didn't know when I was 19, 20 years old is one of the companies that my friend works for and owns part of is one of the companies that tried to recruit me back when I was crushing it as a 21-year-old. So it's kind of a full circle moment where, now I'm doing what I was doing when it all started for me, just at the highest level.
So as they say, everything happens for a reason, right? Wow.
Yeah.
Well, I'm going to get into what it is you actually are doing now. But again, I am so impressed with your how old are you now, if you don't mind me asking?
Turn 37 next month.
Incredible. Well, again, congratulations on all your amazing success. And I know it's only going to continue. But let's get into what you're doing now, because I think it makes sense. It makes all the sense, actually, in the world that you would have the full circle moment, because you have been in the chair of business owners and people selling businesses that need the kind of planning that you know how to do. And I think that's a great segue. So first, describe the company you're with and give us a demographic on that. And then I really want to get into two areas that I know you guys focus on.
Yeah. So Leverage Capital Partners, we do high-level life insurance. But instead of traditional premium financing where our clients would pay $250,000 plus annually for their premiums, our clients don't come out of pocket for their premiums. It's just a leverage play for them. Mm-hmm. So instead of them using their liquidity, we use their assets in a leverage type of way.
So let's slow down. I'm a big believer in premium finance. I told you, Skyler, I've seen it work extraordinarily well. There are groups around the country that use this pretty exclusively to put the premium finance deal inside of a South Dakota trust for a whole myriad of reasons, and we've been doing that for a long time. But even before Bridgeford, when I was practicing law and was up Bank of New York Mellon after that, I learned a bit about how it works. And I would love for you to kind of break it down and first talk about it in its traditional sense, and then juxtapose that with how you say using leverage is the better way to go, and why. Because I think our audience, it reminds me a lot of PPLI, which I know you're an expert in as well. You hear these concepts in the insurance space, but sometimes the average planner doesn't really know how these things work mechanically, and it's a missed opportunity, right, for a large family, in my opinion. So take me through, like I say, go through the traditional model, and then compare that to what you're doing, please.
Right. Yeah, traditional model, traditional premium finance. The bank comes in, you have assets. They loan against the assets where you're paying the interest on the loans, whether it's $100,000, $200,000 over the next, say it's a 10 pay or a 20 pay where you're paying $100,000 over 20 years for your policy. For us, it's a little different. The structure is completely different. So the assets could be the same. We use real estate, we use land, we've done watch collections, car collections, gold, trading cards, Birkin bags. We get very eclectic because, people that have a lot of money, they usually have a lot of stuff. So,
I'm just laughing about the bag. So you can use the Birkin bag somehow. I like it.
Yeah. So we figure out what asset they want to use. We then put it into Irrevocable Life Insurance Trust that you mentioned. It usually sits on the bank's balance sheet. We use Goldman Sachs as one of our business partners. Okay. So it sits on their balance sheet. Then Goldman will go out and raise bonds in the public market. The bonds will then cover the premiums of the policy, and the client never comes out of pocket for the policy. So it's just a leverage play for the ultra wealthy.
Okay, I understand, and I love it. So talk to me, though, about the variation in interest rates, right? Because I've heard it, the only caution is that the arbitrage can be disrupted if there's not a proper way to monitor what's happening with interest rates. Or does this model avoid that? Talk to me about that.
Yeah, interest rates are definitely one of the variables and the risk. So with our structure, it's SOFR 30-day plus 135 basis points that the bank will tack on. Okay. So we're sitting at around 5.5%, 6% safely. But the one thing with the traditional model we've seen time and time again is it's usually underfunded and it underperforms, whether it's tied to a different index, not the S&P, or someone's trying to do something outside of their own situation.
Right. And that's what blows the arbitrage. Is that?
Exactly.
Yeah. I've seen those really explode. I obviously can't name names to protect the guilty, I guess, in this case. But there's a very, very large bank in the Northeast and trust company, one of these mega organizations, who got involved with premium financing, and under the same roof, they sold the insurance, they put the trust in place, they created a lending mechanism in an older traditional model that you described, and of course, it blew up. And it was a big deal, and ultimately the trust was moved to Bridgeford, and it settled in litigation. But I mean, the conflict of interest on that obviously was everywhere, and that bank got smacked pretty hard by the court in a separate disciplinary action. And so I tell that story to say that there's some moving parts here that have to remain separate and independent, which is often why we're brought in, because they want the trust company to be completely independent from the lending bank. Right. And I think that, I've seen too many times that point is missed, and then the arbitrage gets blown and everybody gets sued, as they should. So talk to me about that.
Yeah, we do the same thing. So we definitely keep everything separate. Mm-hmm. The funding will usually bring in a trustee from a third party, or if they have a trustee that's already working with the family that they want to appoint, that's also an option that we usually do. But it's always separated from the bank for the reasons you just spoke on.
Well, and it's such a hot area right now, not that and PPLI, and there's, especially with PPLI, there's a big tax play, which we'll get into in a minute. But, we realized a while ago, Bridgeford, because we were working with some very large law firms, and they're partners of the law firms. We're doing premium financing or doing PPLI, and they wanted the benefits of South Dakota law in particular. And as I'm sure you know, that has, I think, the lowest basis point, premium tax basis point, that is. And so we developed a specific business line that, rather than use a trust, because often people didn't want a trust, the traditional ILIT, they could buy the insurance inside of a South Dakota LLC, which was cheaper, and still be able to get the benefits, the tax benefits, that is. It's all it is a tax play for a lot of those folks. And we have a couple of hundred of them now, and they're growing. But that's because of that, that's where I've really gotten a glimpse into your world and really understand the demographics, so much so that we became pretty enamored of it and thought about us getting into the business years ago, but then decided, we're independent and we're independent for a reason. And we want to we didn't want to get out of our lane and create an inadvertent conflict of interest. So I love what you're doing. I love keeping it all separate. It's very much our paradigm as well. So explain to me, and everybody watching and listening, about walk me through a case study. What's a perfect scenario, the client that can most benefit from this, and talk about what is the actual benefit. Why do, and not just to, it's not just to avoid having to make a premium payment. It's not. It's bigger than that. It's a whole part of a whole planning package, which I would love for you to get into.
Yeah, so I'll actually give you three different scenarios, because it'll touch on the three cases I see most.
Great.
Usually it's our young professional athletes or young entrepreneurs, age 18 to, I'd say, 35. Then you got the middle of the pack, where it's the entrepreneurs that have a family, their businesses are growing. They don't have a whole lot of liquidity, and their businesses are going to be a lot larger down the road. And then you have the big families that, have billions in the bank, and we're structuring multi-$100 million policies for. I would say those are the three types we see. Starting with the athletes, it's more of a annuity type situation that we structure for them. So, one case study is we had an 18-year-old, first year in the league, got a signing bonus of $1 million. That $1 million stayed with his wealth advisor. We leveraged that through an agreement where that was the leverage that we used for the policy. And then when he's retired in, say, 15, 22 years in that time frame, then he'll pull money, which was roughly $400,000 tax-free for the rest of his life.
That's amazing.
Yeah.
That's amazing.
That's
wow.
one structure.
So is that how you became so involved in the entertainment and sports industry, is through that particular example?
Yeah. With the athletes, that's usually what we structure.
It's incredible. And I mentioned earlier as we began, that's how you and I connected, because we both really enjoy this organization called Trusted Advisor, which caters to that demographic and the entertainment community overall. And we had Matt here, the founder of it, on our podcast. And I always like to mention it because I'm so impressed with it. And I would imagine it's been a tremendous resource. It brought us together. So I'm sure it's been a great resource for you.
Yeah. I actually recently joined 2 months ago, I think it was, just because I had so much going on with the business and travel that I just didn't have time to sit down. So now talking with Matt and Brian on a regular basis, and they're extremely helpful in a lot of different ways.
Absolutely. Well, and they're going to be able to bring your solution to all the other advisors because this is, I think we've already heard how compelling it is for that particular space. So talk about the other two examples.
Yeah. So the other two examples, I would say the one that I mentioned in the middle is the one I see the most. For example, I have a guy right now, he's 55. He has a very successful business. We're structuring a $75 million policy for him. He's going to have a huge estate tax issues in the future, but he doesn't have a ton of liquidity. It's tied up in his business. So he doesn't have the ability to pay for a normal traditional premium finance policy because his premiums are going to be, a couple $1 million a year.
Crazy,
right? Yeah. So for this, we're leveraging some of the real estate he has, which is roughly $15 million worth of real estate to cover the premiums and the structure. So down the road, right away, he'll have $75 million in a policy. And as time goes on, that'll grow to, I think it goes all the way up to $180 million by the time he's 90.
It's incredible. Without any money coming out of his pocket.
Exactly.
Well, I want to talk to you about the third demographic a little bit, and then I have some technical questions for you. But yeah, go into the third area.
Yeah, the third one, that's for our largest clients. I call it the Rockefeller structure. It's more like an internal family bank. So right now we're doing a $350 million policy for a patriarch where he's writing a $10 million policy on each of his kids, each of their kids, each of his grandkids, and so on and so forth. And it continues to grow in perpetuity as each person passes away and just funds the family bank where they can borrow against it tax-free, structure loans internally so they don't have to go out to an actual bank, and they set the structure for everything moving forward. So we don't see a whole lot of those because they're usually pretty large, but those are some of the fun ones because we get to structure a lot of different things.
Yeah, no, you can use all the creativity. So a couple of technical questions that I think I would imagine some watching and listening would have. First of all, are there a lot of banks that are willing to do this? You mentioned Goldman's your primary, but it seems to me that I don't see it as risky, but I would imagine banks are traditionally conservative. So is it difficult to find banks that are even willing to do this?
Yeah, we have 15 banks on the platform right now, and we have had some banks pause it just because they're very real estate heavy. But I wouldn't say it's difficult to find banks. No.
Okay. So let's go back to the broader question, though, around the bond that you say, because it sounds like that's really the real magic to this thing. So walk us through what that looks like and how is the interest set? Because it seems to me that the bond has to set the interest properly in order to maintain the arbitrage. If I'm understanding this correctly. So can you get into the more detail there?
Yeah. So the bond is a VARDO bond, VRDO bond.
Say it again. I'm sorry. Say it again.
VRDO, VARDO bond.
Got it.
Yep.
Okay.
Yep. So what the bank will do is once they have the asset aligned and they have to figure out, it's usually we'll raise two 5-year tranches, and we won't raise any more money after that. Okay. And the reason we do 2-year tranches is because we don't want to have to pay interest on the whole 10 years up front. So we do 5 years and 5 years.
Got it.
And one thing that's good about that is the client doesn't have to do their medicals every year. They have to wait 5 years, or if we're using a home as their asset, we don't have to do a new value of the home every single year. We can do it every 5 years.
Good.
So that helps in a few different ways.
Sure.
As far as the actual bonds, the bonds do have an interest rate that's set at SOFR 30-day, and then the banks will tack on an extra 135 basis points as their fee. Because what they're doing for the ILET is they're getting it credit enhanced, and then they're getting it S&P rated. So the ILET will take on ownership of the bank essentially, so they can go out and raise bonds in the public market through the ILET.
That's very helpful. That's what I didn't understand. Okay, so keep going.
Yeah. So once they do that, the bank will then go raise enough bonds to, one, cover the premiums, but they'll raise more bonds to also cover the interest of the bonds. So the client will never come out of pocket to cover the interest or the premiums. So it's self-sustaining.
So that's how the arbitrage is always maintained.
Yeah.
Got it. No, I think it's the way you describe it, it makes so much sense. And I think for those listening, I mean, this is a real tool, and I've seen this work. I mean, not to be honest, Skyler, I mean, you're the first person I've spoken to that does it this way. I've seen the traditional model most always, but not this. So I think this is a tremendous differentiator and very creative. And I can imagine your clients are very happy with the result.
Yeah, I come across a lot of clients that are paying, $250,000, $500,000, $750,000 a year, and they're struggling, or one, two, they don't want to pay for it. So I have a quick conversation, say, you don't have to pay for these premiums. And they're like, what do you mean? And we usually do a reduced paid up, where we use the cash value of the policy they already paid into as the collateral for a new policy. So they still have some of the life insurance that they're already paying for, but they don't have to pay any more premiums. And then we can usually get them about 2 to 2.5 times more insurance than they already have for what they already paid.
Got it.
So when they hear that, it's kind of a no-brainer for them.
For sure.
Which is nice.
So it's in the same, vein of creative insurance. Let's shift focus to private placements life insurance a bit. We've had that talked about a few times throughout the last 3 or 4 years on the podcast. And really what I'm interested in is, can you just draw distinctions for me between the two? I mean, and maybe why a different demographic would benefit from a PPLI, perhaps more so than a premium finance, or maybe you're going to tell me, no, that's not true. So give me some thoughts on that.
Yeah, for PPLI, we're bringing in hedge funds and larger banks, and there's a different type of arbitrage. So the structure is very, very different. We're also, the way we're structuring it, we're using a lot of, what do I want to say? Sorry, my mind just went blank.
Well, that's right. As you're thinking through the thought, I mean, I guess my question is more to the point is, when do you recommend PPLI over premium finance, or do you do them in conjunction with one another? I guess I'm looking for the attributes. When you do your discovery with the client, when do you say, okay, I'm going to talk about PPLI now, or I'm going to talk about premium finance now, or I'm going to talk about both of them?
Yeah, usually the people we're talking to PPLI about is usually $500 million or north.
Okay.
Like right now, we're doing a $5 billion policy for
Amazing. Wow.
publicly traded company. So we're doing 5,000 guaranteed issue policies on each of their top 5,000 employees. We're doing $1 million per head. 750,000 goes towards the company. $250,000 is gifted to the employee as a benefit of being a top employee.
Yep.
Then it's an arbitrage from there.
Yeah. No, I was going to say that's where we're seeing it so much now. It's like an employee benefit. So the idea I mentioned before is, with these law firms, all their partners are invited to participate in the program, and then all those partners drop those PPLIs in a South Dakota. Well, they buy them within a South Dakota trust, not a trust. I'm sorry, a South Dakota LLC, as I said. Yeah. And I'll be honest. When the first law firm came to us, I thought, well, we can do it. Obviously, we're a fiduciary, but I just didn't. In my mind, I'm thinking, well, why not? Why would these families not want trusts? And often they don't want trust. It's only a tax play. So that's where the PPLI LLC program that we have is growing. Every week it's growing. It's really incredible. And again, it's given me a great glimpse into the system. And thanks for drawing that distinction, because again, we're the same way at Bridgeford. When we sit down with somebody, it's an issue spotting question, right? It's always an issue spotting question. And some people are coming to us for asset protection. Some people are coming as for just the tax play, as I said. So we have to figure out what the right solution is for them. And in terms of PPLI, what carriers do you like in that space? Because it's changed. I mean, I know Lombard is really not Lombard anymore, and I mean, it seems like every couple of years there's different players.
It's changed a lot. And as far as the PPLI space, that's not my strong suit. I don't spend all my time there. That's more of my partners. I'm the young guy in the company, so I'm more on the other side of it. So I'm still learning. But I think what we use there's a new company that we just brought on that does a lot of our guaranteed issue.
Mm-hmm.
We bring in a third party that kind of makes it hands off for us, because if we have to do 5,000 policies, that'll take forever.
It's a big process.
Yeah. So I don't know how to answer that question exactly.
Yeah, no, it's just such a changing industry. Even if we knew the answers today, it'd probably be different tomorrow, right? Because it's just changed so fast. Our whole industry is going under a massive consolidation, obviously, and including my industry, which is crazy because, when we first started Bridgeford, there were a bunch of independent trust companies like ours. Now we're the exception, and in fact, now we're the oldest and largest independently held trust company in South Dakota, which is crazy. And it's more a function of how many of our competitors have been selling themselves into private equity, and they're just not independent anymore. And I'm sure you're seeing that all over the place as well. And that's why it's hard to know, who the players are from day to day, because it just shifts. And I think that's a challenge for clients too, and families too, because it's how do we all keep up with who the players are, especially when you're looking for an independent solution. I think it's a little frustrating.
Yeah.
But going back to the premium financing, I love the approach. And for our listeners, Skyler's information, of course, is going to be connected to this video and audio, and I highly encourage you to reach out to him. This is one of those big ideas that I didn't even know existed, at least the nuance in terms of how traditional premium finance can work in this way. And you should be congratulated not only for the unique solution, but again for everything you've done in your career. I'm embarrassed to say I've only started a couple of companies, and I thought I was an entrepreneurial guy. I don't even think I can refer to myself as an entrepreneurial person anymore after talking to you, Skyler. Seriously, congratulations. You should be very proud of what you've done, and I suspect you're going to continue to do big things through the course of your career. So before we let you go, is there anything else you'd like to add or share with our audience?
Yeah, I just want to say thank you for having me on the show. And, being an entrepreneur is not all, it sounds great, right? But that's not the truth all the time. It sounds like I've had all the success, but it's been up and down, rocky roads, highs and lows, as we know. So, it's been a fun experience and a lot of learning.
So my joke is always I was a lot taller and better looking before I started these businesses, and the stress and the toll and the worry made me look like how I look now, which is why I'm even surprised they let me get on video for Bridgeford, but that's a different conversation. We'll have that conversation at Baba over a couple of drinks, which I look forward to. I'm glad that we connected, and I'm looking forward to doing some great work together, and of course seeing you in Naples soon.
Yeah, likewise. Thanks, David.
Thanks again for listening to Bridgeford Trust Company's Delivering Direction and Control podcast series. Be sure to subscribe to our podcast to keep posted on when new episodes are added. And for more information, you can visit us online at bridgefordtrust.com.